All right, so we've looked at the job order costing process and how we figure out what that job order cost sheet looks like. What's also happening in the background that I want to keep reminding you of is journal entries. So we have to be journalizing this when we're moving these inventory pieces between the buckets. They're actually going in different accounts. So before I start talking about that, I will just say that at the end of the reporting period, on your balance sheet, you're going to have assets and you're going to have cash and accounts receivable and all of that. But you're going to have a raw materials account. You're going to have a work in process account, and you're going to have a finished goods account. Those are all inventory accounts. We're just keeping track of inventory in different stages, okay? So I have this sheet filled out for you already in your notes, and I want to explain it quickly, and then we'll do an example. I expect that you know a lot of this already because you're comfortable with debits and credits. If you have questions or it's not ringing a bell, make sure you're referring back to your textbook because it goes through each one of these examples one by one. So first, when we purchase raw materials, you've done this already, you just maybe didn't do it with raw materials. We debit an asset called raw materials, and then we pay for it somehow. We credit cash or accounts payable. When we use the raw materials, we talked about this last time, we're putting it into the WIP account. We're really taking it from raw materials and we're putting it into our WIP account. They're both assets, so raw materials goes down, the WIP account goes up. You're taking it from one pocket and putting it in the other. When we actually use the direct labor, that means our employees are clocking in and out, they're working on this job. We increase the WIP account. Remember, the WIP account is increased by materials, which we just saw right here. It's increased by labor, which we see here. And it's increased by overhead, which is coming next. When we apply overhead, when we take that rate that we calculated, whatever it was based on, and we figure out how much goes into this job, we increase the WIP account, just like you see here. And we need another account that's going to go with that. So for overhead, it's a little bit more complicated. So we have this account we call factory overhead. If you just call it overhead, that's fine. What's happening here is we're applying overhead. This is when we're estimating the overhead, we're getting a rate, and then we're putting it into a specific job. We credit that account when called factory overhead when we apply the overhead. This is what the journal entry looks like. There's a debit to the WIP and a credit to this factory overhead account. When actual, and maybe I'll even switch colors for this one so it's clearer. When we actually have overhead, that goes on the debit side of our overhead account. Okay, that goes on the debit side. So here you'll see that we're debiting factory overhead and crediting cash or accounts payable. So it's actual. This is when the utility bill comes in for the manufacturing plant and you're actually paying it. So cash or AP, and then the debit is to this holding account we'll call factory overhead. Okay? We then finish our job. We're done working on this one project. We transfer it out of the WIP account and into finished goods. Again, now WIP account is going down, finished goods is going up. We're just moving it from one pocket to the other. This is where we pick up with what you probably remember from Accounting 1, recording the sale. We debit cost of goods sold and we reduce inventory. That's the third bucket. Now inventory is going down, cost of goods sold is going up. We're not seeing the sale component, the receipt of cash or accounts receivable and revenue. So that would be happening at this time too, but I'm trying to just show you what's necessary from this perspective. And then lastly, what happens is at the end of the reporting period, we said it's going to be very unusual for your estimated overhead, what we've applied, to be the same as your actual. So there's going to be a balance over here or over here, the debit or the credit side. That's what tells you how much you need to adjust. Okay, this last entry is a little bit clearer if we work through an example. Okay, so we're going to look at an example together. We have Jorgensen Co., a manufacturer of specialized fittings for heavy machinery. They use a job order costing system because there's some customization and component. On the 1st, Jorgensen makes its estimates for the coming month. It expects to have $12,000 in manufacturing overhead. It expects to have $100,000 in materials, $3,000 in direct labor costs. So that's 300 hours at $10 per hour. And that's not exactly clear how I have that written there. They decide to use direct labor hours to allocate overhead. So the first thing we need to do is early on in the year, early on in the month, we figure out the rate. How are we going to apply overhead? We take our estimated overhead, we divide it by something they've decided on direct labor hours. So we divide it by the estimated direct labor hours, and we get a rate of $40 per direct labor hour. Okay? All right, then the next thing that happens the second of the month, Jorgensen purchases $100,000 in raw materials on credit. What does the journal entry look like? Well, we're just debiting raw materials. It's an inventory account. Just like when we buy something, we create an asset and we bought it on credit, so we have accounts payable, and this is for $100,000. There were materials requisitions for January. It looks like we have two jobs, job 325 and job 322. So there were two materials requisitions. If we look at the total of it, it's $100,000. I'm just going to make one journal entry for it. You could do two, that would be fine. So think about what's going to happen here as I'm writing this. I'm taking something out of raw materials and I'm putting it in a job. That would go into the WIP account, another inventory account, and it would take out some raw materials. So now we don't have the raw materials that we had before. We're reducing it by $100,000 because that $100,000 in materials is coming into our job. Okay? Labor is paid in cash for the following time tickets. Okay, so our employees work for us. They're working on these jobs. They're clocking in, they're clocking out. We know exactly which jobs they were working on. This is direct labor. Okay, so it's direct labor. It goes into the WIP account because we're showing in the WIP account what this job cost us to make. So our WIP account's going to go up by $2,500. The credit here, it says they paid in cash, so our credit is just going to be a reduction in cash since we're paying our workers, $2,500. Okay, a couple of you may be thinking, well, should there be separate WIP accounts for each job? That may be easier, and that would be how it's done in real life. We're just going to keep going like this. All right, so now overhead is applied for job 322. I need to remind myself of how I'm applying overhead. I'm using direct labor hours. I've calculated my rate up here. So it's estimated overhead, estimated direct labor hours gives me my rate. And then I apply that rate based on actual hours for each job worked. Okay, so if I come over here to job 322, I can see that actual hours of labor were 150. So to figure out how much overhead I should apply to job 322, I take my $40 rate and I multiply it, I'll just put my rate here, by actual direct labor hours because that's what I chose. It doesn't always have to be that, but that's what I chose. Actual direct labor hours of 150 for job 322, and that gives me overhead of $6,000. Okay, remember when I'm applying overhead, remember when we had our factory overhead account, applied goes over on the credit side, actual goes on the debit side. So 6,000 is being applied. Okay, think about that journal entry. We know the credit is to the factory overhead account for 6,000. The debit is to the WIP. Remember, the WIP is keeping track of the total cost of making that job. All right, so think about that for a second. We're going to keep going. The next thing that happens is that this job 322 is done. It's moved to finished goods inventory. Okay, so I'm going to quickly draw us a little job cost sheet for number 322, so just so we can make sure we understand. The direct materials that went into 322, if I come up here, were $55,000. So I have direct materials, $55,000. The direct labor that went into job 322, $1,500. And then the overhead is what I just applied to this job, $6,000. Okay? That gives me total of $62,500 for job 322. Okay, that's the total cost for me of making that job. So when they tell me that job 322 is moved to finished goods inventory, this is what's in the WIP account right now related to that job. And I need to move it from the WIP account into finished goods. So I'm going to take it out of the WIP account with a credit. I'm reducing that asset, that inventory account, and I'm just putting it in a different inventory account called finished goods. And the amount is all the costs of that job that have been piling up in the WIP account. Okay, so I've kept track of this. You could also think about your WIP account as just a T account, and the direct materials, the direct labor, and the overhead are increasing your WIP account. That's also a perfectly good way to think about it. You might want to think about the WIP account for just job 322 so you don't get confused, but either way you want to do it is fine. Next, the job is sold for $80,000 cash. You've seen this entry in accounting 1, and now we're just going to go for it again. So cash goes up by $80,000. We call that sales revenue, $80,000. We need to record the reduction of inventory. So we record cost of goods sold. What should cost of goods sold be? Whatever it cost us to acquire that inventory. It was $62,500 for us to acquire that inventory. How did we acquire it? We made it. And then the credit is a reduction to finished goods. It's not there anymore. We sold it. All right. Next we have actual overhead costs for January are $11,000. Okay. This overhead is primarily utilities and the manufacturing manager's salary. These costs were all paid in cash. Okay, so think about that for a minute. Actual overhead costs for January were $11,000. What is happening there? We got a utility bill and we paid it in cash. Okay, so what do we need to do? Well, the easy part may be first seeing that we've paid cash of $11,000. Now we need to think about, shoot, what should the debit be? Well, the debit is going to be factory overhead, $11,000. Okay? Think for a second about what our overhead account looks like right now. Our overhead account, we put actual on the debit side, applied on the credit side. The applied has $6,000 in it from job 322. We're going to put $11,000 over here from this debit entry. And that's kind of where we are right now. All right. The next step, overhead is applied for job 325. How are we doing that? We're taking our $40 rate per direct labor hour, and we're multiplying it by the actual amount of hours for that job. If we have to scroll back up, we can see that there were 100 hours for that job. Okay, so we apply the overhead for job 321. we take our $40 rate and multiply it by 100 actual hours on that job and get $4,000 in overhead applied. Remember how we apply overhead. We debit our WIP account. Remember, job 325 is not done yet. That's still going. And then we credit factory overhead. So, and that's for $4,000. So now I'm going to record this credit over here. We've applied a total of $10,000. Actual at this point is $11,000. This is just going to keep going until the end of the month or something like that where we true it up. Okay? Now job 325 is sold for $60,000 on credit. I probably should have stopped here and had it moved to finished goods. So I should probably add and move to finished goods first. That would make more sense. Let's over here do a quick job cost sheet for job 325. Direct materials for job 325. Let's go back up and see what they were. $45,000. Okay, $45,000 in direct materials. Direct labor for that job. We scroll back up and look at how much labor has gone into it. $1,000. So there's $1,000 in labor. Now we need overhead. We just figured out the overhead that's going into that job is $4,000. We total that up and we get the cost of $50,000 for this job. So first I'm going to move it to finished goods. I'm going to debit finished goods, $50,000, and credit the WIP account. So now my WIP account has nothing in it. There's nothing that's in process. Now I'm going to sell it. So I'm going to debit accounts receivable, $60,000, sales revenue or just revenue, $60,000. And I'm going to record cost of goods sold for whatever it cost me to acquire that asset, $50,000, and I made it. And then I just take it out of my finished goods inventory, $50,000. Okay, so now my WIP account has 0. My factory overhead account, I'm going to highlight right here, still looks like this. Okay, it's still there like that. My raw materials account doesn't have anything anymore. My WIP account doesn't have anything anymore. I just sold my finished goods, doesn't have anything anymore. The only thing that's really still open is my factory overhead account. Okay, so now it's 11/31. I need to adjust and see where I am with my factory overhead account. Let me grab a different color for us. So if I total these at this point, I would end up with 1,000 on the debit side. There's 11,000 on the debit side, 10,000 on the credit side. That means my actual overhead is $1,000 more than what I applied. Okay, there's always going to be a little bit of a difference. Okay, so let me maybe draw a clean factory overhead account down here for us. There was 11,000 actual and 10,000 applied. That means I have a balance of 1,000 on the debit side. My actual was more than what I applied. I don't want you to memorize what happens here. I want you to think it through. When actual is more than what you've put into the job, that means you think job 325 costs $50,000, but that's a little low. You thought that job 322 cost $62,500. That's a little low because it turns out our actual overhead was more than what we thought. Okay? We talked about the choices when this happens. I'm $1,000 off. I have $1,000 more in manufacturing costs than I've dealt with at this point. So what I'm going to do is I'm going to make an adjustment. To adjust factory overhead to 0, I need $1,000 credit. Okay? And then this account will be zeroed out. So I'll just put a 0 here. Okay? So I know I'm going to credit factory overhead for $1,000. That's what has to happen for this to go away. The debit can be WIP, finished goods, or cost of goods sold. Those inventory accounts that are holding those manufacturing costs. These would be increases. I'd be increasing the WIP account, increasing finished goods, increasing cost of goods sold to reflect the fact that the manufacturing costs were $1,000 more than I've accounted for so far. Because the WIP account doesn't have anything in it, we've finished everything, but really finished goods doesn't have anything in it either because we've sold all of these. They're in cost of goods sold. So what makes the most sense here is to increase cost of goods sold by $1,000.